Folks, back another week, Creative Financing with JB. Got a very good, interesting guest, cohorts in the lending industry. Just gonna blow y'all mind with things that's happening now. Like I tell everybody, we have so many different options when we're doing stuff. We pass on business. I mean, some people, everybody's not for me. Everybody's not gonna be for Greg, but I'm gonna let Greg just break it down. He's gonna give a background about himself, how he got in this environment and everything. And we just gonna have a good conversation. So Greg, man, thank you so much for coming on. My audience is going to be shooting us some questions here in a minute, but man, just give us a little background of how you got into this mortgage industry. I mean, what just said, boom, I'm going to start doing this lending stuff.
I'll tell you what, it's an interesting story, Johnny. I appreciate you having me on. We've been friends for a long time, and it means a lot to me. You know, I got into this industry by having a bad experience, honestly, in the lending world. I bought my first house 22 years ago. I've been in the business 21, and it wasn't quite the experience I thought it would be. And I was kind of out of college. I was looking for work. I had a finance degree, wasn't really sure where that would take me. And by happenstance, I got a job offer in the mortgage world by a childhood friend. And just that coupled with the experience I had, I thought there was a better way to do it. And here I am almost 22 years later.
Right. And I mean, it takes a lot, well-respected folks. I want to let you know, well-respected. I seen Greg perform great business he does, you can learn from it. I learned from it, when I was doing processing and title stuff, that is so many intricate details in his business, Greg, that a lot of folks don't even understand, We got folks that just want to come in, and it's great to come in, but you got to have some type of dynamics, some type of understanding of it, and like some of the and you probably can break down. I mean, some of the challenges that I had was mine wasn't the people, mine was learning the ins and outs of the underwriters and what they call for and stuff like that, and we all have those. When you first came in, you probably had a mentor, something that somebody that really helped you through this. That folks didn't know. So, you can just tell us about some of your mentors or folks you work with to help you design where you are today.
Yeah, I appreciate it. And I think we might have a bad connection. I'm getting a little bit of a background interference there. So hopefully I got your question. But yes, I was out of school. I was looking for work. I ran into a childhood friend of mine just randomly. This is before social media. These were times where we weren't as connected as we are today. And that gentleman that I ran into was a childhood friend. And he saw the writing on the wall with the old MBNA before it became Bank of America. And decided that was kind of his catalyst to starting his own thing. He was in the mortgage department with MBNA, kind of branched off and created a company called Laver's Mortgage, which we successfully ran for about 8 or 9 years. We were a small brokerage, a boutique. And, I learned everything from him. But, the reality is we were learning together, too. We kind of both got into it at the same time. Certainly, we stumbled a little bit, made a couple of mistakes, but never made the same mistake twice. And, learned valuable lessons. We were always transparent with people. We did all the research we could because at the end of the day, when you're dealing with people's lives and their finances and their livelihood, you need to produce good answers, and you need to have good mentorship to do that. You have to have good, just people in your corner that can really lead and guide you as you're newer to this business. And then, as you become more veteran, you can develop your own styles, but you need to be a sponge when you first get in. Right. That's the biggest thing. Be willing to learn, willing to work, willing to be coached. And that was what did it for me. And, it's a very just rewarding business to be in. I love working with people. I love helping people. I love the fact that no 2 days are the same. Right. No two people are the same. And you kind of have to be a chameleon. You know this, Johnny. We work together all the time, right? Yeah. So, but that's what keeps my toes tapping, right? I love the excitement, the hustle and bustle, the pace. And I like to be counted on. And, in turn, I like to deliver good and superior service. And ultimately, that's what it's all about.
Wow, perfect. That's perfect. And now we are from Laver's. We've been at Annie Mac. How many years now, Greg? we've been at Annie Mac?
It was 12 years, June 1st, so a little over 12 years, which coincides with my anniversary. Hello to my wife,
Right.
Stephanie. It was 2 weeks ago.
Yeah.
Can't forget that, right?
Right.
But yeah, when we had Levere's as an independent brokerage for about 8 or 9 years, and just decided that we wanted to kind of align ourselves with a bigger company that had more resources behind it. And when a lot of people in any industry make a move, a lot of times it's out of pain or out of frustration or what have you. We made it out of opportunity. And I think that was really big because sometimes knee-jerk reactions can occur when emotions run high or you're not happy in a certain situation. And that's just life, right? We vetted out 8 or 9 companies over a period of a year and decided Annie Mac is where we wanted to plant our flag. And we haven't looked back. It's been a great experience.
Wow. And tell us a little bit about Annie Mac. How big are y'all? Company size, where y'all range from, and all of that.
Yeah, so we're headquartered in Mount Laurel, New Jersey. It's about an hour up the road from me here in Delaware. We're licensed in 47 states. We pretty much do all lines of mortgage and finance with the exception of commercial. We don't do commercial, but everything else pretty much we have our hands on and we can help people with. We have about 60 branches total. When we joined, we were the 11th branch. That was a long time ago. So we certainly have grown, not just organically, but also exponentially, on a national stage. And we're definitely a top 20 lender in the nation, and we continue to grow in market share.
Wow, and that's awesome. And we see a lot of programs out here, Greg. And one of those, I know we don't offer, is one of your programs, that Cash for Keys, which is a big game changer in this market. And folks, if y'all not familiar with it, I'm gonna let Greg expand on it a little bit more. But Cash for Keys is sometimes we have to sell to buy that home, and Greg's program kind of prevents that from happening in a way of that program they set up. And Greg, you can break it down a little bit, that Cash for Keys, because I know with contingencies in a contract, that's I'm not dealing with that. With this, it takes that away. So you can let us know about that Cash for Keys program and stuff like that.
Best program, Johnny, I've seen in my time in the industry. And I know it's probably easy to say that for a lot of us, but there's 2 programs. There's Cash to Keys, as you mentioned, and there's Buy Now, Sell Later. The difference between the two is that Cash to Keys is for someone that doesn't currently own a home, such as a first-time home buyer, and Buy Now, Sell Later is kind of in the title. You have a home to sell and you're looking to buy another. In this market right now, inventory is really low. Interest rates are on the higher side. It's difficult out there. And when you have, let's say you're a buyer and you're a first-time home buyer, let's say, and you're looking to make an offer on a property and there's 8 different offers, there's a hierarchy there on the listing side, right? That listing agent's looking at all cash offers first, your conventional 20% down loan second, and everything kind of falls, in line. We want our offers to be put at the top of the pile. We want to give our buyers a fighting chance. We want to give our realtors, our buyers agents, hope. And that's the best way to do so. What we do at Annie Mac is we want to Cash to Keys is that we will guarantee the purchase of the home that they are under contract on, the buyer, in all cash. That's through addendum on the contract if their financing doesn't come through for whatever reason. That could be through job loss. That could be through a client just getting cold feet. That could be for a client's credit score drops because maybe they missed a credit card payment, as an example. But no matter what, we are going to deliver those funds on time. So it's, in essence, an all-cash offer, and that pushes our offer to the top of the pile. Johnny, statistically speaking, 1 in 6 offers gets accepted nationally, whereas with Cash to Keys, it's 1 in 1.5. So you have a 4 times more likely chance to get your offer accepted Cash to Keys than you would otherwise.
Wow.
Buy Now, Sell Later kind of works the same way. You have a house to sell. A lot of people, when they make an offer, they got to go contingent upon the sale of their current home. That's a deterrent sometimes in a multiple offer situation. Same logic applies. We will guarantee the purchase of that new home if that client's current home doesn't sell first, thus eliminating the contingency altogether.
Wow, and that's amazing, because folks, I'm be honest, we don't offer that. We gotta pass that on, and I always tell folks that everybody has a niche. They have a program out there. We gotta fall into those programs that happen. It's enough business for everybody. We just gotta make it reasonable. So if somebody ever came to me and say, "Yo, I got a contingency," it might not work with me.
Right.
It might not work with me. You got to find that, because when you have that, it's not about yourself. It's about that buyer that we have, that we're trying to get in that home to build that relationship, because we could never hinder another buyer from getting that home that they really want. And what better way to do it, is to find somebody with that program. And I always look for those things and for those niches and refer people to that, because you keep the relationship good. Greg's a lender, I'm a lender. I mean, we all want to win. We all can win. How do we win? Passing on, building relationships. Yo, Greg, you might be able to take this. I can't do nothing with it. Raise my hand. And in the lending world, you have to be able to do that. You really have to be able to set that aside. Hey, Greg, I know you want to say something about that.
Yeah, I'm sorry. Yeah, so exactly right. I mean, we have other lenders that will refer us deals that can go cash to keys because maybe they can't do that program. There's things I can't do, or that maybe we're not the strongest at. And when you have a good network of peers, such as you and I being not just peers, but friends, buddies, we go back. You have your niche products, we have ours. There's enough out there for all of us to eat. But the bottom line is it's all about the client, right? Client satisfaction, getting people into homes. Because the reality is there's some frustration out in the market right now. We have an imbalance, right? We have too many buyers and not enough sellers. So you got to put your best foot forward. You got to, have the tools in the tool belt to find success. And this is one that allows it to happen.
Yeah, for it. And it's important. I tell all of our audience out here every week that, as y'all see Greg's number go across that screen, utilize it. I mean, call him, he might have that program that's efficient for you that we're talking about right now, because my goal is never to see somebody lose a house because I can't do the program. That's unacceptable to me. It doesn't make sense. And, we keep going, forward and stuff. And maybe the next one comes around because it's enough to share. But understanding these programs for buyers, it enhances and it gives you credibility out there when you're placing that offer. And you're able to write a good offer, because, with a contingency, I'm going to tell you right now in this market, it's going to be tough. It's going to be tough.
It's going to be tough. And one success story that comes to mind is that I went to a high school with a gal that was a year younger than me. We know each other by name. We're more acquaintances than friends, but we're on social media together. And she had seen some of our Cash to Keys advertisements that we put on social media. She had been looking for a home for a year and a half. She made 6 or 7 offers, was striking out. Was ready to wave the white flag and said, you know what, I'm going to give Greg a shot. And she gave us a call. Got her Cash to Keys approved, first offer accepted. Doesn't always work out that way, to be fair, but in that instance, it did. So I'll leave her last name out there. But Naomi's her name. We went to high school together. It's a great success story, and she's really happy in her new home.
Wow. And Greg, what made Annie Mac say, hey, man, it's Cash to Keys. This is a program. I mean, I thought that was wonderful thinking, whoever thought of that program for it.
Yeah, we have a gentleman in our corporate headquarters named Wes Costello. He's very involved with finance. He's also a licensed attorney as well. And, we're always looking for ways to stay ahead of the curve. We're always looking for ways to get people into homes. We're always looking for ways to overcome challenging times. And I can't tell you exactly how it was born, but what I can tell you is that there was a few folks that got together in our corporate office about 3 years ago. They came up with this brilliant idea. With any idea, there's kinks that you have to work out. So they beta tested it just in the state of New Jersey initially for about 6 to 9 months, because that's where we're headquartered. And once we felt comfortable for a national rollout, then we did so. It's been nothing short of amazing. The biggest challenge, frankly, is getting education out there to our realtor partners, to our clients, to let them know this isn't gimmicky. This is something that works. And, while the rollout was a little bit slower than I've liked a couple of years ago, it's like pushing a boulder down a hill. Once it gains steam, it keeps going faster, and it grows bigger like a snowball that you roll downhill. And that's kind of the analogy I use often. So, shout out to Wes Costello. He's a great guy, a great mentor, great employee of Annie Mac. I've been there longer than I have. And to answer your question, that's how it all was born and how it became about.
Wow. Yeah. And that's amazing, to have the program. I get excited about new programs, new stuff that come out. We hear about down payment assistance, all that, but this is a prominent program that you're not going to find a lot of folks with it. And Greg, shout out to Annie Mac on that. And, a great team that, with Mike, and have a couple more folks. And tell us a little bit more about your team here, that y'all have at Annie Mac.
Yeah, great team. I mean, I can't speak highly enough about our team. I have the pleasure of representing us, from the branch manager perspective, but ultimately it's the team that's within the four walls that really allows us to be successful. And I'm proud to say that, we have multiple people, 5 people I can think of right off the top of my head that have been with us 15 plus years or more. So not many people leave, but many stay for a long time. My business partner, Joe Ingwe, and I, we grew up together. We've been together 21 and a half years now. Mike Jewell, you mentioned Mike a minute ago, high school classmate of mine. Mike was in my wedding, going on year 17. Multiple folks with 10 years plus experience. It's one of those things where we just believe in transparency. We believe in teamwork and culture. We believe in open door policy and open lines of communication. And I'm fortunate enough to represent this team on this call, our team on this call, but ultimately it's the people behind the scenes and within the four walls. And I can't help, I have to mention rather our processing team. I mean, our processing team is the backbone of our success, led by Valentina McBride. She's also been with us 21 years. Valentina's bilingual, and then Sandra, who's also bilingual, and Chloe. They're the engine that makes it go, because you can have great interpersonal skills, you can drive business, you can do loans well, but if you don't have people that can process them and get them through underwriting, you're only as good as the next person, right? It's like an assembly line. If any part jumps the track, the whole process can become derailed. So it really takes a team effort and a village of people that are all, linked together to get things done. And I feel fortunate that we have that team.
Somebody just sent a question. Your 1-Up program, Greg. Y'all have a 1-Up program?
We do. That's a little bit more intricate. I'd probably rather talk about that offline, because there's some bells and whistles there, and I could spend 20 minutes talking about it. But it's an FHA program, certainly something that we can do. There's qualifiers there. So, I don't want to evade the question, but it's a little more complex for probably a forum like this. But whoever asked the question, they can certainly give me a call tomorrow, email me, and I'd be more than happy to answer that.
Perfect. Yeah, they asked the program. That was something new. I didn't even know about a 1-Up program. Somebody's doing some homework that looked the stuff up, and they shot the question, and folks, that's good that we have these questions. If you're reading and stuff and you want to ask it, Greg's numbers floating on the screen. It's good to have that conversation. It's good to reach out. You probably heard about some of the stuff they did, or somebody shared those, and just it's a good conversation, because then you can understand what it is for it, and everything. We have conventional programs, we have temporary buy downs, bank statement programs, FHA cash out refinance, I-10 mortgage programs, DSCR, jumbo, all those programs is in this lending industry. But I tell everybody, Greg, everybody's different. I'm different from Greg. Greg's different from Mike, and it goes in a circle. So when you call in to ask about these programs, don't say my friend got it. So Greg and Johnny, you should be able to give it to me, and that's a misconception, and there. And I'm gonna go on a note of misconceptions in this broadcast, and Greg can probably allude to it even more, that you have to know where you are when you come in. You seen somebody, you think you're equivalent to them, you have to know about this. You have to know your debt to income ratio. You have to ask those questions. And first of all, you got to be forthcoming. If Greg or myself writing a loan, just let us know right now where you're at. And me and Greg was talking about this, tell us at the beginning so we don't get in the middle.
Yeah. Yeah.
And a whole bag of sand. We're like, what is this going on? You have to let us know what's going on. We see a lot of stuff happening in the industry. And Greg, you're pretty good with interest rates. You done seen them way longer than I have. And, I explain to folks, and you can chime in, that interest rates is only a dating session. It's a dating session until you get to that point. You can marry that thing, and we've seen it. So, Greg, you can allude to COVID versus now. What have you seen?
Yeah, I mean, it's been a systemic shift, right? I mean, COVID was a once in a lifetime thing, and during that time, times are really tough. A lot of people were out of work. A lot of families were struggling. So what the government did was they artificially pushed interest rates down to all-time lows to incentivize existing homeowners to refinance their mortgages. Why? Well, to free up money for the average American family, right? It was a great thing. It had to be done. We were going through tough times during COVID. That said, we were printing money to keep the economy afloat. We were doing stimulus. We were doing small business loans, things of that nature. And what we in essence did was devalued our dollar. We call that inflation, right? And we hear this word all the time. So it was kind of a slingshot back the other way over the last couple of years. And now we're seeing rates that we haven't seen since 2007, 2008. So it was I don't think any of us expected that. It was whiplash, and myself included, honestly. Wow. But, it needed to be done. And now we're dealing with these struggles in the economy as a whole as to when is going to be the right time to bring interest rates down. Why not creating further inflation? And that's something that's the federal government's, or the Federal Reserve rather, is constantly dealing with. But what I tell people is this, Johnny, I have clients that will tell me, well, I'm just going to wait for interest rates to go down and then I'll go buy a home. Right. In theory, it doesn't sound bad, right?
Right.
You know this.
Right.
You don't know.
Right.
For every percentage rate, a mortgage rate goes down, let's say from 7 to 6% as an example, 4 million new buyers come into the market nationally. Okay. Now we have capacity issues, right? Because we still don't have equilibrium between buyer and seller. So yeah, you might get a better rate if you wait 2 or 3 years, but now you're paying more money in rent, or maybe you're living under your parents' roof longer than you like. And maybe that house that you were going to buy at $300,000 is now going to cost $3.25 3 years from now. So yeah, you might have got a better rate, but you waited a lot longer. You paid your landlord a lot longer than you needed to. And ultimately you could have bought the home now and just refinance it in a few years, which is what I recommend. I know you recommend that, and any loan officer is going to recommend that to their clients. Now, there's no substitute for not being ready. If you're not ready mentally, by all means, wait. I'm never going to push somebody or put the full court press on them to buy a home. If you're not ready, you're just not ready. But if it's strictly interest rate driven, you don't want to wait. You'll be sorry down the road if you do.
And folks, you hear, the rate might be up there. If it's affordable for it, if you're in it, something that you own, why wouldn't you do it? The question is, why would you wait if you can do it? Because you spending that rent money right now on something else. What's the benefit for you? Are you really saving anything when you think about it? And I ask folks that, what are you really saving? I'm saving. I don't have to pay myself back, because remember, that's your equity in the house. Right. I don't have to pay myself back that extra money. Well, I'll pay myself back.
And think about this too. Houses have gone up. Now there's pockets obviously throughout the United States, but on a national scale, home appreciation is at 35% over the last 3 years. So if you would have bought that house 3 years ago and ignored the rate thing, again, it's important, but that $300,000 house would have been worth almost $400,000 right now. So you've left a lot of equity on the table by trying to play the interest rate game, we call it. If we all knew when to sell high and buy low, we'd all be millionaires, but we don't have the benefit of foresight. So to your point, John, if you find something you're comfortable with the monthly payment, just know that appreciation will continue, not those levels, but roughly 5% a year. And then you can refinance the mortgage and avoid the bum rush, as I like to call it. Right. When rates go down and everyone that's been sitting on the fence kind of gets off that fence and gets back in the market.
Right, and stuff. So somebody asked, how do I know I'm ready for a conventional loan? Folks, I said this at the beginning. Everybody's different, you know. It's criteria. Date the rate, marry the mortgage. Come on, Robert, you talking now. I like
Loving it.
that. I like that for it and stuff. And Greg probably gets that question. People come to them, Greg, why don't I qualify for a conventional rate? You know, it's so many factors that play a part in that conventional program. It's so many things that taken to granted. So I can't just say, Greg, you qualify for a conventional rate because you got an 800 credit score. No, that's not what we base this on. And Greg can tell you that we look at so many scenarios when we're doing that for that person and where they're at in there. And Greg, one of your pet peeves when somebody asks that question, I mean, I said 100 times, you know, you different, but it's no other way for me to put it. And everybody's different.
Everyone's different. I mean, there's three things that really drive interest rates. It's your credit score, of course. It's your down payment, which we call loan to value, and it's what's known as your debt to income ratio, which is a ratio of what you make every month versus what's going out. You know, as far as how do I know if I can qualify conventionally or FHA or what have you? The first thing to do is sit down with your loan officer. You know, complete an application, have a soft credit pull done. Ultimately, for me personally, I put myself in front of everybody. It used to be more in person. COVID kind of changed the way that we do business in the world these days. So now it's more of our Zoom or Teams calls. But I will break that down for every client. You know, I will say, hey, this is your debt to income. This is the down payment we're looking at. Subsequently, this is the loan program that's best for you. But ultimately, if I see room for improvement, I'm going to offer that up, obviously. Not many people are aware of this, but in conventional lending, you know, rates are done in increments of 20 points. So you get one interest rate if you're between a 660 and a 680 credit score, and slightly better from 680 to 700, and so forth and so on up the ladder, right? So the one thing that I always suggest to people is meet with your loan officer as soon as you can. It's imperative. I'll have folks say, well, you know, my lease runs until next June, so I'll just give you a call next April. And I'm like, no, let's talk now, because ultimately that gives us more time to work with things. And if your credit's already great, then so be it. At least you know it, right? But even a 760 credit's going to get you better rates than a 740. So timing's everything, preparing's everything. And if you're working with the right person, they're not going to put pressure on you. If you need to wait that year, that's fine. But go see your loan officer yesterday versus tomorrow, and you'll be better for it.
Yeah. Greg, somebody said, tell us about the 20% down myth that we hear.
It is a myth, not required. You know, this is I call this the Leave It to Beaver days. You know, that was kind of our parents' generation, right? Where you either had to do that or you were facing the consequences of much higher interest rates and so forth. The reality is that the majority of people, overwhelmingly, especially first-time home buyers, do not have 20% to put down. Okay, we'll do mortgages for as little as 3 to 5% down, and some are even 0% down in certain cases, such as a veteran's loan. So you don't have to put 20% down. What's the byproduct if you don't? Well, you do take on what's known as private mortgage insurance. A lot of times those rates are very low, especially with an FHA mortgage, or if you have higher credit scores on a conventional mortgage. And you could always refinance out of that PMI, that private mortgage insurance, when you do acquire a 20% equity stake in your home down the road. So I believe in cash is king. I encourage people, if you can put 20% down, by all means, please do so. But don't do that at the expense of maybe not fully funding your retirement, such as your 401k, or if you have other consumer debts like credit cards, things of that nature. I think we're so quick to want to put down as much money as we can on a home, while maybe neglecting other things that maybe should be moved more to the forefront. But it's certainly a myth. You do not have to put 20% down.
And we noticed that since COVID, the question said, we noticed since COVID, the bank statement program has been so new to it. How has that changed the industry some, in your opinion?
It's been a game changer. I mean, the reality is that, you know, anyone that's self-employed is writing off as much as they can on their taxes, and rightfully so, right? And a lot of times you'll have folks that make this much but show this much, and maybe they don't qualify for a normal government loan, like a conventional or FHA loan. This is where creative financing comes in. And that's your title, right? Of the show. So we will derive an income from bank statements. If you're self-employed, let's say you're making, monthly deposits, we will generate an income from that. We also have DSCR loans, which stands for debt service coverage ratio. Johnny, you're aware of these as well, of course. And, we can do it off of future rents. If you're going to buy a home to rent, we can get a rent schedule through the appraisal. And there's many, many more programs that exist like this. These are called non-QM loans, which stands for qualified mortgage. They were pretty much non-existent 5 years ago. And now more than ever, they're relevant in today's, lending universe.
Yeah. And Robert had a question that came up on that screen there. Is it true you get a better rate with the builder and the finance company if you're buying a new home?
It's possible. I mean, when builders are doing, if they have in-house financing companies, there are incentives for builders sometimes to keep that business in-house. So they will dangle that carrot, oftentimes in the form of a lower rate or money off closing costs or builder incentives, things of that nature. So as long as you're aligned with someone that you're comfortable with, as much as Johnny and I might lose a client here or there to a builder, at the end of the day, I know I can speak on your behalf as well as my own, that we just want what's best for our clients. So
absolutely.
There are times that would be the case.
Yeah. Isabel saying, what advice would you give young people who are first-time homeowners searching for the perfect mortgage?
Yeah, I love this question, Isabel. Preparing, as I mentioned a minute ago, I mean, the time to start is now. Even if you're not buying a home for a year or two, it's the equivalent of like asking that girl for that first dance, in seventh grade, right? Like there's nervousness. A lot of people feel anxiety about coming to a loan officer, coming to a realtor, because they might feel like, well, I don't want to sound silly or uneducated or unknowledgeable. But the reality is that's our job to educate you. And you're only going to buy 3 or 4 homes in your life. So start early, Isabel. Put yourself in front of the right loan officer. Have them educate you about the process. Have them do a soft credit pull. And allow us as a lending community to put you in the best position to be successful in the future.
Yeah, and first time home buyers, you have to get out there, you have to get a plan. You can sit back there, you can hear something, but Greg and myself, I'm going to tell you, you got to sit in front of somebody that's going to really get you to where you need to know. You have to have the understanding what we do. I always tell people, respect the advice. Respect the advice, because the advice that you're getting is to guide you through the process. It's not to mislead you for it, and to give you the honest to goodness truth. If you're not ready, you're not ready. But guess what? Let's get ready, for it. Let's prepare you for that. Let's make sure that you're investing your money correctly, for it. Down payment assistance programs, folks, I tell you, are the greatest, for somebody that needs help. But should you put yourself in a debt situation doing a down payment? I'm gonna say no. Be able to have some money, because once you move in, if you don't empty that bank account, and Greg knows, the first thing you're gonna look for is what can you sacrifice, and when you say that, what I'm gonna sacrifice, it can't be the mortgage.
Right. Exactly.
It can't be the mortgage for it. So we're mindset on that, to where we're saying, hey, I know you see that nice 325 house, but you right here at maybe 215 for it, and go from there. Robert Dickinson said, Isabel Baker, yes, the sooner the better. Go for it with the due diligence and research. And that's correct. That's why we sit up here. We talk, we want to instruct these folks, what you need to do, how you need to get it for it. Somebody said, Greg, what's your opinion on investment properties? Do you think it should be in a 3 or 5 year period after you buy your home?
That's a great question. I own investment properties. I started young, and I'm a big fan. Real estate is, in my opinion, the safest investment that you can make. If you go back to 1942, and you can look this up on a Google search, there's been 5 years out of however many years that is, 90, 80 years, whatever it is, 83 years, where we've had negative appreciation. 5 since
Wow.
1942. The average appreciation rate over that time is a little over 5.5%. 4 of those 5 years, Johnny, were during the foreclosure crisis between 2007 and 2011. So notwithstanding those 4 years, we've had 1 year since 1942 that we've seen depreciation in real estate. So you want to talk about a great way to build wealth, right? So start young, start early, start when you're ready. And we mentioned the landlord thing earlier. If you're a landlord and you own an investment property, now you have your money working for you versus working for your money. You got someone else paying down that mortgage for you. And anyone that's a landlord, such as myself, will tell you the best thing that you need to be doing is vet your potential tenants out the best you can. It's all about the tenant in that game. You got to find the right tenant. You got to find that someone that's going to take care of the place. It's going to pay you on time. And now Zillow has Zillow Rental Manager, which I use, where you can list a property for rent. You can require that potential tenants have a credit report pulled on them, and they have to pay for that report. And those results get sent back to you. So the last property I rented, I had like 30 applicants, and I was able to kind of, rate those, if you will, as far as the safest bet that I thought it would be for myself. Showed the home to a bunch of folks, and then ultimately made the best decision.
Wow. Yeah. And that's important. I tell folks, investing's great. You have to do your due diligence. You have to vet that tenant, especially if you have a mortgage on that property. Excuse me, because the worst thing you can do is know that you have your own personal and this due, and you have nobody there paying that. So it's either you're going to work harder, you're going to have to find a way to do it, or, you're going to be faced with being in foreclosure. And you don't want that when you get into this thing. So you have to vet through a lot of this investment properties, like we was talking about the DSCR loans and stuff like that. They're good, they're great. But if you don't have somebody helping you in that realm of renting, what good is that investment property to you?
That's right.
So you have to keep that in mind.
Yeah, and don't be afraid to lean on those that have kind of blazed that path ahead of you. There's no need to recreate the wheel. When I have clients that ask me, specific clients that ask me about that, I'm always willing to lend my expertise and my own personal experiences, because that's important, because other people did that for me when I was trying to blaze that path. So it's about aligning yourself with the right person that's going to give you the right answers, that's going to show you the way, that's going to provide you solid mentorship. And yeah, I mean, as long as you vet the clients out, get the right programs in place on the financing end, I think it's a home run. And the earlier you start, the better.
Yeah, and folks, I'm gonna let Greg's email run across you. If you're scared to call, send a text. Drop him an email at gclark@annie-mac.com. So you can kind of open those questions up. It's good to have conversations. It's good to get more than one opinion. I tell folks, when you get some news from a doctor, you go and you vet that information. It's the same thing in this game here. What we're saying here is real good and healthy for you, that you get that understanding, you get that knowledge, because somebody might have missed out on something. I'm not perfect. I can forget something. Greg's not perfect. He might forget something, but it's good to have that conversation so we know what's preparing for. And we talk about investment property. We're talking about longevity wealth right now, of getting something that can stabilize you from the future. Somebody asked me the question, Greg, what was your biggest mistake in investment properties? And Greg, I'm gonna let you go first. I know not betting the tenant.
Yeah, and this is a great question, because obviously none of us are free of mistakes, right? I've made them myself. We've all made them, right? When I first started renting to potential tenants, I put too much. I lean too much on the emotional side versus the business side, and I let a tenant in once who had a dog that was well trained and this and that, and the dog's great, doesn't tear up the carpets, doesn't whatever, and it was an utter disaster. And I did it because the tenant pulled at my heartstrings, and they really came across as genuine and very nice, and they were. I mean, they were great people. But at the end of the day, I let that cloud my judgment and put myself in a situation that cost me thousands in repairs when they did leave. So, as much as we all want to, exercise humanity, and as much as we all want to be the nice guy and what have you, you do have to treat it. It is business. It doesn't mean you have to be cutthroat, but you do have to vet people out. And, sadly, people that have issues, whether they're credit related or what have you, everyone seems to have a story, and it's not for us to be judge and jury on who's telling the truth and who's not. With the way the rental market is now, you're going to have multiple applicants. Do your homework, vet people out correctly, and then choose the best person that you feel like. Just like when you're interviewing somebody, for a job, you're going to vet them out. You're going to look at the pros and cons and choose the best candidate for that job.
Mm-hmm. And Robert said, do you have a property? I'm pretty sure a property manager, or do you do it yourself?
I personally do it myself. However, I will say, in fairness, that I also in the business, right? I do mortgages. I have the acumen from doing this for a long time. And I have the temperament to be a landlord. Not everyone wants to be a landlord, and I get it. I understand. So if you don't have that background, that temperament, that time, that doesn't mean that you're not going to be a great landlord. You could just simply pass it to somebody that has that expertise and still, invest in a great investment. So I personally do it myself, but I've had clients I've spoken with, and when I kind of get the feel of who they are and what they're about, sometimes I do make the suggestion that maybe a property manager would be something they should look into.
Yeah, for it. And it is, like Greg said, it's not for everybody.
Right.
Because you might not know the rules, the laws, when it comes to evictions. It's a lot to go on in there, and in the vetting process. Like he said, if you're dealing with your heart instead of, a business mindset, you can run into some deep waters here for it and everything. And you got to keep that into perspective when you're doing this business, because remember, this is longevity. It's not short-term stuff that keeps going. Somebody asked me, can we do a temporary buy down on investment properties? I never heard of it.
No, I haven't either. Certainly exists in the primary residence world, but no, we don't have that product. I don't believe that anyone does. I've never heard of it.
Right. Yeah, and folks, when you're in investment properties, it's right there, invest, so you got to have some money that you're going to put forth into an investment so you can see the return on your money. If you're looking for buy downs and seller's assist on investment properties, it's probably not your time right now. And I don't mean to sound harsh or, insensitive to it, but, you got to look at you're putting money into an account, I want to call it, which is property, and you're hoping to gain and grow from that. And that's what happens. I can't just go to the bank and say, yo, give me a loan, and I'll put it in an account and do that. I still got a payment on that loan.
That's right.
So, you got to keep that into perspective. And I want to go back to the question about the builders and stuff like that. We hear this all the time. The builders have their mortgage companies and everything. If you go in there, I tell you always two things: walk in with a realtor, if you don't have any knowledge at all. Somebody that can guide you through that process, somebody that can talk you and walk you through that, and get a second opinion on your lending. For it. They might give you so much money, $10,000 down, but Greg's able to look at it. I'm able to look at it and say, well, this would happen here. So it's a break-even point for you if we do it, or some people say, well, look, lender said they give me $20,000 and stuff. And, your upgrades might be $84,000 instead of $70,000. So, those things happen when you go to builders. Man, our builders is great. I love our builders and everything, but we always have to get that opinion and always give that advice that, hey, we're not knocking what they're doing, but we're seeing if that's the best bang for our buck.
That's exactly right. And that's such a good point, Johnny. Especially with representation, both points, of course, but the builders, if you let them work directly with you, they're going to work directly with you because they don't have to pay a realtor. But the reality is now you have a conflict of interest, in my opinion, because they're obviously going to represent their best interests.
Right.
Maybe not so much yours. Not that they're going to get
Right.
over on you, but if you have a realtor that's representing you in that transaction, you're going to be much better for it. And ultimately, the builder's going to pay your realtor's commissions anyway, 9 times out of 10. So, if you can seek out free representation and have the builder pay your representation, your realtor, you should certainly do that, especially if you haven't bought a home before. But I would suggest it always.
Somebody asked me, what's the accuracy on a loan estimate? What percentage would you consider that it's going to be lowered? A loan estimate is a loan estimate. It's an estimate of what's happening here because, we don't have definite insurance numbers. We need taxes, especially when we're doing new builds. I mean, we have to figure that out. So we have to give you an estimate. Sometimes it's the worst case scenario but you have to prepare your mind for that. You can't say, oh man, that's too much for me. We have to give you something so you can gauge where we're going to be at. And when you're gauging it, and Greg, you can comment on that too.
Yeah, I learned early and often that I always give a worst case scenario. That's just me personally.
Mm-hmm.
There's things that we aren't aware of, and Johnny touched on a few of them, such as your homeowner's insurance. For the same reasons you don't buy a car insurance until you buy the car, right? So when we give you an estimate, if you're not under contract on a home yet, there's no real way for us to be able to tell exactly what your homeowner's insurance is going to be. That said, Johnny and I have been doing this long enough to know approximately where you'll be, right? So I always beef it up a little bit, but I'm also fully transparent in that. And I learned a long time ago, if someone comes with a couple grand less than they thought at closing, they're loving you for it. You're high-fiving. If they come with $1,000 more than you told them, they're kind of looking at you like you're a crook, right? So at the end of the day, I always overestimate. Sometimes I'm in competition with other lenders because somebody might seek out more than one estimate, and that's totally fair, of course. But sometimes I see some competitors that will go too skinny on it. I'll point it out tactfully, of course, but you do want to add a little bit into that as a buffer because things can happen. I had one not long ago where our buyer had to represent or reimburse rather the listing agent, the seller for oil. There was oil left in the tank. It was like $1,400.
Wow.
Had I not overestimated, my estimate would have been short by $1,500, right? And that would not have been pleasant. And I always say 90% of surprises in our industry are very unpleasant. We like to avoid those, right? So there's just things that can come up. It's always wise to, just to give a little bit of a worst case scenario.
Rob says, so the best thing you can do out of a builder besides a few incentive in the house is a decent interest rate for it and stuff. And Rob, I'm gonna tell you like this, and I tell folks, make sure that's a true interest rate and not a buy down. Because it's a difference when you come to that perspective. And Greg can even tell you, they might come to you and somebody said, well, they give me 4%. I'm like, I haven't seen 4%,
Yeah.
So let me see what you're talking about. So they might have gave you that $10,000 or $12,000, and that's to buy down your rate for that. And Greg, just break down a little bit of that buy down rate because folks might get a little confused with that buy down rate, a buy down and a permanent buy down.
Yeah, so a buy down has to come from the seller side of things. Okay, so basically, what the seller is going to do, if it's an existing home, instead of offering like seller's assistance as an example, it's almost the same thing, really, just coined differently. But they can put up $15,000, let's say, and then there's a buy down table that might say something along the lines of like a 3-2-1 buy down would be a lower rate in year one, slightly higher in year two, and then the full rate in year three. And that allows you to kind of graduate into the payment. In other words, let's say interest rates today were 6.5%. Using that example, year one, you'd be at 4.5%. Year two, you'd be at 5.5%, and year three, you'd be at 6.5% thereafter. It could be very effective in getting to a home, affordably for those first couple of years until the time to refinance comes down the road. So we do expect rates to drop here, I say by the end of 2027, but that's even a crapshoot these days. We don't really know. So it's kind of a carrot that a builder, an existing seller can dangle in front of a buyer to entice them to buy their home by offering them cheaper terms over the first couple of years.
And you have to be very aware of that, because after that first year and you get this notice that your mortgage up at 1%, what's going on here? Do I got an adjustable rate and all that stuff? No, this is the buy down. We were hoping that they dropped down and the rates didn't, so you're gonna have to go up your 1% for it and stuff. You have to be prepared for that, because you can't accept that payment shock. When you start hitting that payment shock, the first thing is that I'm selling this thing. But you got to think of, you just invested some money in it. Are you going to have enough to get rid of it?
Yeah, and you got to make sure it's a true buy down. I mean, if
Mm-hmm.
the seller of the home is just juicing the sales price by 15 grand to accommodate that, really you're
Right.
paying it at that point, right? So
Right.
in my opinion, it would make sense not to do that. Yes, you'll have the slightly higher interest rate for the first couple of years, but you'll ultimately refinance that rate. And believe me, you'll pay a lot more by doing it on the buy down way. If it's truly, you're
Mm-hmm.
paying for it, you better off just refinancing, not taking that option. So it really just depends. This is where your realtor is going to come in. This is where your loan officer is going to come in, provide advice to you, educate you, but ultimately it's your decision to make.
Yeah. So folks, you have a team. You have your realtors, you have your lenders, the buyers. You're going to sit down as a team, talk about the strategy of the plan you want. We're not gonna talk outside the realtor, but we're gonna say, hey, this is the whole plan. So when you're submitting that offer, you're looking at that house, you're out there driving around and stuff, you know that you have to stay within that plan, because you can get diverted when you see stuff nicer and stuff, and you got to come back to the table, because I'm gonna have to, man, I'm at 385. Greg, I seen that house at 385. 385. I know you got me at 350 right here. You think you can get $35,000 out of it? We got to go restructure that stuff.
Yeah, for sure.
For 35,000 don't seem like a lot, but it can change a whole lot. And
it
so,
can. I'm sorry. I was just gonna say, Ken. I mean, it's really important to just have the right team around you. All too often too, I see folks that will, everyone's has good intentions clearly, but maybe just find somebody randomly online or whatever. I would encourage you to speak to family, friends, people that have had good lending experiences. I wouldn't just, open up the yellow pages as an example and just randomly choose people, because you don't know what you're going to get. You need people in your corner. Can't believe I just said yellow pages. That shows my age here, but you got to make sure you have the right people around you, and that's the biggest thing, because ultimately when you're going into something that might be foreign to you, such as finance, especially as a first-time home buyer, it's really important that you can lean on others and have mentorship that's going to lead you in the right direction.
Yeah, for it and stuff. Somebody said, I hear that I-10 buyers require 20% down. How true is that?
For us, that is true. We do require 20% for I-10. I don't know. I can only speak to our product line. Johnny, you might say something different here. But our
It's
I-10s do
normal.
require. Yeah, it is. Okay. Yeah, we require 20% down.
Yeah, for it. So it's normal for it. And you have to think of, that this was required. And folks, this is not the loan officer say, hey, you need 20% down so we can make more money. This is a guideline. This is not a gadget where we just put the numbers on there. We follow guidelines that investor requires. That's gonna, after we're done, they might purchase that loan or sell that loan. So we have to meet their requirements. People say, why? Because we don't service loans.
Right.
You got to think of the service part of the loan. So when we're coming to you and we have conditions and stuff, understand that it's our investors that's going to go ahead and buy that loan on that market. And you cannot deter from doing that, because now in our industry, you got to find somebody to service that loan, the taxes, the property taxes, manage the payments, set those escrows up. That is time consuming for it. And it's just not something that somebody sends a check in and we just throw it in the bank. And then when the tax comes in, no, it's a lot more to that. So when you start hearing these conditions and the down payments and stuff like that, we're not just throwing numbers out there. It's guidelines for it. Unfortunately, that's what the guidelines are, and it's got to meet it. That's why we started the program with special products they have. And Greg alluded to it. It took 6 to 9 months for them to try that out and see that it works, so you can be able to have that product to share with everybody. Because if that 6 to 9 months didn't work, we not marketing that product. We not selling that product out there, because it's not going to be good. It's not going to be a good reputation. It's not going to be good for the consumer, and we don't want that name to hinder us for it, folks. And this is good resources, good information, for, I tell y'all every week we pass this stuff on so you can see it. It's a difference in everybody. As Greg number keep going across the screen, Greg Clark, 302-561-4941. Send a text, send a call, whistle, say something, so you don't put yourself in that. Get an opinion, get knowledge, I ask all the time, because things happen so much over and over and over again. You got to stay abreast of what's going on out here, how our market is, why's our interest rates like that? And, you're going to be able to say, Greg, these interest rates are terrible. Tell me what's going on out there. He's got to give you understanding why you see that, because you won't understand what's going on. Or, Greg, oh man, can I get the 5.5%? That's not available. Somebody told me that they want to pay $24,000 to go down to 4.75. I said,
Yeah,
it doesn't make sense.
It doesn't. And we would do break-even analysis, and there's things that we will do internally to kind of help you, guide you in those decisions. Kind of as I mentioned a minute ago or a few minutes ago, every client I personally meet with, it's 30 minutes minimum. It's a Teams or Zoom call. I share my screen and we answer the questions that Johnny just went over. Why is the interest rate market where it is? Where do I personally qualify? We open it up for questions. There's no such thing as a bad question. And it's more of an all-inclusive mortgage 101, where we can educate you as best we can, because ultimately knowledge is power. And the more knowledge you have, the better decisions you're going to make. And, for some clients that are first-time home buyers and maybe a little bit on the more novice side, if you will, I'll do 2 and 3 calls, because at the end of the day, if somebody walks away unclear, uneducated, I consider that a personal failure of mine, so it's very, very important that we take the time, we align ourselves with the right people, and we're getting all that stuff out of the way so we can make sure that you're out there making good decisions.
Yeah, I didn't want to ignore this question, Greg. It said, how do I know that I'm getting a jumbo loan?
Yeah. So if you got a jumbo
Greg,
loan, that's a good problem to have. Every
right.
every county, every state, there's different lending maximums, if you will. There's conventional lending maximums. So in our area here in Delaware, it's 806,500, I believe. So if your loan amount is higher than 806,500, you're in the jumbo category. Now, if you buy $1 million house and put $300,000 down, well, that's 700,000. You're not in the jumbo category. So anything above and beyond that 800 plus, 806 plus number would be considered jumbo.
And that's perfect. That's the best way to break it down for you. And it's a criteria for jumbo loans too. So you got to look at that. Get that 3.5% out your mind. That's a jumbo
Higher
loan.
down payments for sure. Yeah. And Johnny, you said it best. I mean, everything's relative to risk, right? Like,
Right.
no two people, you mentioned doctors earlier, right? No two people go in and, let's say, apply for health insurance and get the same rates, right? I mean,
Right.
how much do you weigh? Do you smoke? These are all things that move premium. Or if you get car insurance, do you have any accidents or DUIs or, whatever, speeding tickets? These are all things that move the needle, right? So it's never a one size fits all. Everything's relative to risk, whether it's down payment, credit score, debt to income, the loan type that you're going with, like a bank statement loan is an example, which we talked about earlier. So it's never as easy as just saying, hey, what's your rate today? It's
Right.
Everyone's different. And we'll walk you through those. We call them risk-based adjusters. We'll walk you through those during the consultation calls as well.
Yeah. Folks, man, it was so great. I'm honored to have Greg. You see his number go through 302-5619-4991. His email is gclark@anniemac.com. And that's annie-mac.com. I mean, reach out, ask the questions, if it's something I can't answer, go on. Y'all got another resource. I tell you, every week I'm providing resources and opportunities so y'all could be able to, as an audience and as a consumer, to make informed decisions, to be able to know what you're doing out here in this lending world and investment world, to be able to really purchase and feel comfortable. My thing is, if I die tomorrow, this information is no good with me. That's why we pass it on and we keep it going. For you met one of the greatest, one of the GOATs right here in Delaware, But man, I'm so honored and have it. Greg, thank you so much. If you got some last comments before we go, it's all you. It's all you.
I appreciate you having me on the show, Johnny. As I mentioned to our audience earlier, you and I go way back. I respect you as a professional, as a friend, as a colleague, as a peer. Johnny's very, very knowledgeable himself. We always work together really well, even though we're at different firms. And knowledge is power. Meet with your loan officer as soon as you can. Doesn't matter if you're looking to buy 2 years from now. The more time you have to prepare, the better off you're going to be. And it's really just that simple. And it's just taking that first step. You take that first step, it's a huge sigh of relief, because a lot of people are hesitant to reach out to a loan officer or a realtor. I think we kind of run from what we don't know in life sometimes. Mm-hmm. But once you get to that point and you make that initial visit, that initial call, that initial consultation, it gets a lot easier, and we're here to help you out.
Yeah, folks, thank y'all again for attending, watching this Creative Financing with JB with Mr. Greg Clark. We had a wonderful time with you. Use the numbers, use the resources so you can make the best decision. See y'all next Tuesday. Y'all have a great evening.
Take care.